You're probably not going to believe it when I say this, but there is actually a possibility that rate hikes are back on the table. I said it, rate hikes could be back on the table. This coming after the market has suggested for the better part of the last couple of years that we're going to continue to see rate drops. And in fact, literally only 60 days ago, some banks were suggesting as much as 3 rate drops were still on the cable to bring the overnight rate down to 2%, effectively bringing us 75 basis points or 0.75% lower than we are today. So how the heck did we get here where some of the banks are suggesting, RBC namely, that rate drops are gone and rate hikes are actually back? Well, with core inflation coming in hotter than expected, with rate expectations completely basically gone, as I mentioned, and the real estate market stuck between a rock and a hard place, the market is all over the place and completely confused, and for the most part suggesting that we've seen the last of the rate drops in 2025 and we're going to wait it out for the rest of the year before we see any changes. Now I'm going to break down why this is the case, also why they might be wrong, and more importantly, how on earth you could make a decision on buying real estate or refinancing in this type of a market. Plus, if you hang around, I'll get into why I think Canadians are going to spend more money than they need to right now. Welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadden, and I'm your host. I can't wait to get you into the flow. Digging right into the data, let's just get right into it. I'm not going to make you wait. First of all, I'm Alex McFadden here, the owner of Flow Mortgage Co., and you're listening to the Flow Money and Mortgage podcast, where I try to help you guys save some money and keep it in your pocket. Really quickly, if you're enjoying this and you're listening to us on Spotify, give us a great review, send it to a friend. And if you're on YouTube, hit that like button and subscribe, please. Let's get into it. Headline inflation came in just a little bit ago at 1.9% year over year, but that includes a temporary drop from the carbon tax rebate. Hold on, I'm not going to lose you here, and I'm going to explain what this all means. Without that drop, real inflation is at 2.5%. Not good. We don't want to see that. This matters because the Bank of Canada's inflation target, that's the target they're trying to get to, is 2%. Okay, so if you're following along, basically, if inflation is above this target, it signals that the economy itself is overheating. And that means the likelihood of a near-term rate cut is very unlikely, and possibly even a rate hike coming up if it accelerates even further. Now, most people are shocked and surprised to hear that, and you might argue that I'm crazy for saying that, but I'm not. And the data is actually suggesting that this is a reality right now. Now, this definitely impacts a lot of people that are in the marketplace, and it could have a massive impact on how the housing market itself reacts in the near term and more so in the long term. With 2026 being one of the highest years on record of mortgage renewals coming up, you better be paying attention to this information, because a lot of people will probably end up paying more than expected if this comes to fruition. Now, everybody with a mortgage, a loan, or a line of credit is potentially impacted. Higher rates, higher cost, higher interest. As I said before, especially if it hits renewals with variable rate mortgage holders who have been beat up enough over the last couple of years, you'd like to think. Now, core inflation, which came in at 3.4%, which is the highest since April. This is important because this is the BOC's preferred measure of calculation. Now, one of the key items that you need to know about this is it strips out gas and food, and it really helps to break down the trend of what's happening with real life inflation. Basically, think of it as the BOC's like check engine light. When they see this going up, there's like a signal, an orange signal, and they need to be paying clear attention. And that is what the BOC is seeing right now. 3.4% is too high to even consider a rate drop. And if it hits 3.5, most of the economists are saying that another rate hike actually becomes likely, which again is insane. What this has done to actually impact the current rate market is really interesting, because what it's done is it pushes the bond yields higher And if you've been listening to my podcast for the better part of the last couple of years, you know that bond yields going higher, generally speaking, impacts fixed rate mortgages. And we've seen that already. Bond yields officially crested the 3% mark. That was a mark that we were hoping it didn't happen. And when it did, we started to see most banks increase their interest rates or stop giving away the discounts that they've been giving away for the last 30 to 60 days. Now, we've seen them go up anywhere from 0.10 to 0.25%. So there's just no alarm bells or anything like that, but it's more of a slight bump that we hadn't seen in some time and a reversal of the direction that we were hoping to go in the near term. So the key thing here is that if your mortgage is coming up for renewal, you need to be aware that this could cost you more money essentially than it would have before this actually happened. Now, I'm not going to get too deep into the breadth of inflation, but I do want to talk about the fact that inflation is not insulated. It's broad. It considers things like services, rents, wages, and all the essentials. In fact, this move is going to have the biggest impact on the middle income earners. Fixed income households who earn like a specific salary, who maybe don't have the ability to go and sell more or make more money through some other means, are the ones that are going to get hit the most when it comes to these types of things. Their cost of living is rising while their salaries, for the most part, are not rising at the same percentage. And that's what the data is showing. And that's why it is so important to hear this information, which is basically meaning that it's going to make it harder for renters trying to get into the marketplace, which is really interesting because RBC just came out with a study that said this could literally be the most affordable time to buy real estate in the last 5 years or in the foreseeable future. Basically, they're saying that we could be passing a window of time right now where the cost of buying housing right now is about as good as it gets. And depending on which city you're in, you may or may not believe this, but it's actually less expensive to be a homeowner right now in a lot of cities, barring Toronto and Vancouver, where it hasn't been for years and years and years. And the data right now essentially warns that this could only be a very short period of time before these costs change, and those fixed income earners are left on the outside waiting to see what happens. Now, interestingly enough, let's talk about what the banks are saying with this news. First and foremost, Scotiabank and Desjardins, they warned that a rate hike is possible this fall. Like, they specifically, if you're looking at the rate forecast for where rates could go, they suggested that it's not necessarily guaranteed to happen, but this could happen. Now, this absolutely matters because the fixed rate mortgage market is priced off of bond yields, and obviously bond yields spike when lenders adjust rates, and this happens, typically speaking, within days. Now, this is typically going to impact people who are shopping for homes who did not get a rate hold in place or don't understand how rate holds work and have the wrong type of rate hold in place first. And then following that is most likely going to impact people who are renewing in the next 6 to 12 months who decide not to renew or refinance early. There are different lending options. We've talked about this in the past where you could refinance and lock in a rate at an earlier time and pay interest to maturity. But I don't think most people are actually considering this. And this is why it's going to cost them more money than they think. Now, I got to note that there is a wild card, and it is the US. CPI rose from 2.3 to 2.7%, which was mostly driven by housing and services. With the new tariffs being added, especially on things like Chinese imports, like EVs and things like that, these costs are going up. And ultimately, the US is going to have a direct impact on Canada, as it always does. Global capital follows the US currency. If they keep their rates high or inflation continues to go high, then no doubt it will have a direct impact on Canada. And it could force Canadians to see costs go up even more so than the tariffs on their own. All right, so what does this all mean for the real estate market? That's what people really want to know. First of all, the June market recap. I know we're in the end of July, but this is still important information. June actually came in flat year over year, with some markets seeing increases. For example, the benchmark price in Canada was $688,000, but that doesn't explain the fact that there are many markets, regionally speaking, that are on fire or they're doing exceptionally well. 10, 15% price growth in areas in the Maritimes and Newfoundland and areas on the West Coast like Vancouver Island, whereas areas that are slouching behind are those condos in Toronto and condos in Vancouver City. So the national prices really don't tell the tale of what's actually happening in our country. And honestly, it's been a while since I've seen this level of regional output. Areas like the Okanagan in British Columbia are doing exceptionally well, but areas like the Fraser Valley are doing poorly and seeing slight discounts on real estate depending on what you're actually looking at. We have seen sales volume go up compared to last year, but it's still 11% below the 10-year average. So we're still not seeing a lot of people buy houses. That stalemate is continuing. Well, basically, what this all means is not really any more a seller's market or a buyer's market. This is kind of like the most medium ground that we've seen in 2025 so far. Buyers are still waiting for rate cuts, which, as you can tell based on my podcast, probably doesn't make any sense. And sellers aren't under any pressure to sell their real estate right now because they're holding on to their real estate values, hoping and praying that they'll get that extra $10,000 or $15,000 they want to sell their home. There's basically a price war in place right now, not increasing prices or decreasing prices. It's just essentially a holdout, and it's a chess game where no one actually wants to make a move. Now, from a regional perspective, I already highlighted the fact that Newfoundland is way up, supply is down, crazy to look at. Vancouver, Fraser Valley is down 4.1% year over year, a high mortgage cost consideration, and this is having a significant impact on the amount of buyers getting the marketplace. And of course, as we've talked about many times in the past episodes, condos in most markets are sliding down 5.2%, mostly weighed very heavily by the major markets in Toronto and Vancouver. Now, this is kind of important because condos are like the gateway drug for people getting into the housing market. First-time buyers typically get into a condo first and then work their way up. So this deduction or reduction in house prices actually mostly benefits first-time home buyers. It has a negative impact on investors who are trying to offload their properties, but it actually helps out investors who are trying to get into the condo market and take advantage of opportunities that show themselves right now. It also is a good market from a downsizer's perspective of people who are selling single family detached and able to downsize and recognize that the spread is greater for them coming down right now than it has been recently with condo prices coming down. Honestly, what's holding it all together right now and making sure that the market doesn't collapse is that we are down 36% to 36% total debt ratio from 46%, which basically means that even though everything kind of seems like it's more expensive, it actually on paper shows that people who are qualifying for loans are qualifying at 10% less of their income towards their housing and overall debt compared to where it was just a few short years ago in 2022. Essentially meaning that real estate prices actually have come down and people are spending less money overall. And so there is a higher amount of affordability based on people who are qualifying for a loan, even if it doesn't feel that way, which is really interesting. So how do you move forward in a market like this from a mortgage perspective is really what a lot of people are asking. Number one, from a buyer standpoint, if you're a buyer, like if I'm a buyer in this type of market right now, what I'm telling my clients, number one, is be picky. There's more real estate available in the marketplace. It doesn't mean things are going to be cheap, and you're going to buy a house for 50 grand, 100 grand off the listed price if it's 500 grand or $600,000. There's some negotiation, but you have leverage with different types of properties available. If you want to buy, you're going to buy for 5 or 10 years. Doesn't mean you have to wait for 2 years because you're probably going to miss this opportunity if you do that. But what it does say to me is that you have the opportunity to look at different types of real estate that's out there. And to me, that is the win. Instead of just picking something, no home inspection, not thinking it's the right neighborhood, you can actually pick something in the complex you want to be in, maybe negotiate terms, definitely negotiate the dates that you're hoping for, and do really well. This is the type of market that you want to be in if you're a buyer. Also, from a budgetary perspective, you have time to forecast your budget, right? Looking for locations with potential rent growth, infrastructure spending, and limited new supply are different types of things that I would look for if I was a buyer in this particular market. Now, mortgage renewals that are coming up with this information and this data, especially for people at that 5.5% price point, my feedback really quickly is start shopping early and lock in your interest rate. I talked about where we can help people. We have a float down option where, let's say your mortgage is coming up in 12 months. We get you approved today. We lock you in at today's interest rates, and we look at, depending on the lender you're with, to be sure, we look at what's the penalty to break it relative to where the rate market could go. Now, if rates stay the same or go back down, we just do a float down. When we get to the 4 months, we pull your credit, we do a float down, we lock your rates down to what the market is, and we keep moving forward. If the rate market goes up, you have the decision to actually get out, close it, hold that lower rate, and secure that before the rate market goes back up. I think people are nuts not to be considering this right now, and I just genuinely don't think enough people actually know about it, which is why it's going to cost Canadians a crap load of money when you consider that an interest rate could have been locked in at 4% instead of 4.5% literally 3 months ago, or 4.5% instead of 5% maybe in the next 3 months. Now, if you're refinancing, this is a big picture consideration. A lot of people refinance to pay out debt to get access to equity. Well, if these rates go up and property values continue to decline in certain markets, that being said, this is going to reduce your access to equity. Another reason that I think people are going to miss out because they're not thinking about that, getting that home equity line of credit or getting that equity now when home values are high. They're just holding out for rates or end of term. And I think that's going to cost people maybe higher interest debt if they wanted to consolidate it, or maybe just access to the equity for future business or something of that nature. So those softer appraisals are going to be a big consideration. And if you're an investor in this type of a market, honestly, in this market, I'd be focusing on clarity of what your cash flow is. More than anything else right now, run conservative numbers for calculations. Lock in maybe short-term rates, like 3 years at this point right now, to kind of bridge the cycle and see what's happening. And definitely watch for local vacancy rates. Alberta is substantially greater than Ontario right now from a yield perspective in most different communities. And so we're seeing a lot more people head to those different communities. Now, what's coming on the horizon is probably what you're thinking, like when are the next dates? Like first and foremost, July 22nd is the Bank of Canada Inflation Expectation Survey. And that is going to have a huge bearing on the big Bank of Canada rate decision in literally only a few weeks' time or a week and a half, depending on you're watching this, on July 30th. This is big information for the overall market, and it could have a huge implication to what people decide to do when it comes to real estate for the rest of the summer, which is honestly only a month and a half left to go, which is crazy. What I'd watch for is in the fall, we have the potential Fed signals and the global tariff impact will be real because we'll have had a full quarter of tariffs that we'll be able to dig into. What else you'd be watching out to is that if inflation holds above the 3% margin and wage growth stays strong, rate cuts will be pushed out all the way to the end of 25, maybe to 2026, or maybe not even at all, depending on how the market reacts into next year. And we'll be able to really see how these renewals and how these people renewing are going to deal with it. If CPI starts to come in under 2.5 consistently, then we may see some rate relief on the horizon. Now, here's the thing. The market hasn't crashed, and it probably won't unless we have some significant job losses, which is really going to be the thing that the government is looking out for, BOC is looking out for. So this honestly could just be a window in the next 30 days or 60 days to buy without the competition before people decide to shed their homes off the market or people decide to hop in, seeing that the market is doing what it is. Now, I don't know if that is going to be the case, but it sure smells like an opportunity that we haven't seen in a long time. And we just know that looking ahead long term, based on the issues with the fact that people are not investing into the building market right now, and the only thing that's coming up for completion is basically small condos and rental condos, there's going to be a demand crunch sometime in the next few years. We just don't know when it will be. Now, listen, if you have a mortgage renewal coming up in the next 6 to 12 months, your rate is 5.5% or greater, and you're looking to access the equity in your home or maybe just look into locking into some of my options, check out our website at getflowmortgage.ca. Go ahead and apply, set up a call. My team and I will consult with you to do a cost comparison to see if it makes sense. Or find me on Instagram at themortgagepug. Send me a DM and we'll have a chat about your options going forward. Thanks so much for checking out the podcast. We'll see you on the next one.